right now, MicroStrategy's Bitcoin has a slight unrealized loss, whereas a few months ago, you had a paper profit of $4 billion. Zooming in on this and removing the fact of where you think it's going to go, do you ever look at that and kind of go, oh my gosh, like we were sitting on $4 billion of paper profits and that's now gone?
No. If you'd asked the same question to Jeff Bezos in 2003 and said, like you just had an 80% loss in Amazon. Do you ever wish you sold Amazon in the year 2001?
Uh-huh. Yeah.
Jeff Bezos could have sold Amazon in the year 2000 and avoided a 95% loss. For example, Mark Zuckerberg, could have also sold Facebook, just before or just after the IPO and avoided a 50% loss. And, in fact, Jeff Bezos could have sold Amazon 5 different times and avoided an 80% loss. And if he'd sold at any one of those 5 times, he wouldn't be one of the richest people in the world. So I think that that trying to time the market is a trader mentality. But if you look at all the richest people in the world, they're not traders. If you look at statistical analysis of Bitcoin or the S&P, I think the conclusion generally is that like 80% of your returns come in like 1% of the days.
Yeah.
So if you miss the top 3 days of a year, you might lose 80% of your return. If you miss the top 6 days, you lose it all.
Yeah.
So the way this is going to work is it's going to look like you're not making a lot of money 98% of the time. And then you're going to wake up one day and you're going to find out that the sovereign wealth fund of some Middle Eastern country just bought $10 billion of Bitcoin. It's going to double or it's going to triple. And then you're going to be kicking yourself and screaming, saying, oh, well, I could have bought it at blank and I didn't buy it at blank. And you'll be angry. Since MicroStrategy entered the entire crypto economy, we got involved in the second quarter of 2020. We announced a $250 million Bitcoin buy in August 10th. If you look at the numbers since we actually made our Bitcoin purchase, the money supply expanded 36%. The M2 money supply expanded 36% in the US. Gold is up 7%. Gold didn't track the money supply. If we had bought gold, we would be way lagging behind the money supply. The NASDAQ index is up 19%. It barely crawled forward, but it didn't actually keep up with inflation. The S&P is up 29%. So if you bought pretty much all of the desirable companies in the index, it didn't actually hedge your inflation. It lagged inflation. Bitcoin's up 229% since then. And so when you think about that, what's beating inflation? Bitcoin is. What's losing? The traders are all losing, right? And most of the other assets are lagging. And everybody's thinking that they can time the market. But as a practical matter, I think they do a statistic and like 95% of active traders underperform the market. If MicroStrategy was trading, we would just be a public hedge fund. Okay, so the real problem with that is if you're an investor, how do you value a very opaque hedge fund that will do whatever? For example, if I just told you, I bought some Bitcoin, but I also bought some ice cream trucks. I might also have bought some Luna. How would that have worked out? There are thousands and thousands of public companies. People want to invest in something that they understand, that they can trust. So if you're going to be a theme park company, that's what you should do. If you're going to be a movie company, if you're going to be an oil company, you should be a pure play and you should focus, in a laser-like way on that, because that allows a rational investor to put you in their portfolio. For example, like maybe you hate Bitcoin. If MicroStrategy has a strategy, which is we're long Bitcoin, we're levered long Bitcoin, well, then that's good, right? Because now you can short us. It's not a bad thing for people to short your stock because if they short your stock, eventually they're going to have to cover, right there. It's not on the other hand, maybe they like Bitcoin, but they think it's 99% likely to fail. Think about it. You have $100 million, so you put 1% of your portfolio in it, and you want to find someone that actually is pure long Bitcoin. You see, you could probably raise $1 billion in one day if you're predictable, even from people that don't even like Bitcoin. Whereas if you're unpredictable, you could work for 1,000 days and raise nothing. I think that when you're looking at modeling this, you have to be aware of time frames. For example, I mean, a lot of people, they want to read a headline and then they want the price of the asset to move the way they want it to move immediately or the very next day. But in fact, there are very long time delays in these things, 6 months, a year, 2 years, 3 years. So I think that as I pointed out, if you look at the 2-year, the 4-year, the 6-year time frame, Bitcoin is acting very rationally per inflation. But if you look at very short time frames like 6 weeks, you may sometimes get the opposite of the expected effect in the near term. So I think that if you're going to invest in the asset, you have to have a clear idea. Are you a trader or are you an investor? If you're an investor, you have to have a 4-year time frame. Mm-hmm. And then you can only start to make conclusions after you've waited a couple of years. If you're a trader can make conclusions faster. You just look at the correlation. You say, well, NASDAQ traded down 2% today. Did Bitcoin trade down 2% or 4% or 1%? And you're building these back-tested correlated models. And I suppose that works fine. But again, I just think that they're just not intellectually defensible over the long term. Like, for example, the Titanic hit an iceberg. Everybody ran to the deck. Okay. The Titanic sailed into the sunshine and it's a beautiful sunny day, 75 degrees. Everybody came to the deck. Okay. So you've got a statistical model. Everybody runs to the deck. You say, oh, the sun must be shining. It's a great day. Or you built your model and you say, oh, everybody ran to the deck. We must have just hit an iceberg. But you see, at the end of the day, it does matter whether or not you hit the iceberg or not, or whether the sun is shining. And the statistical model won't tell you the difference between the one or the other. Both of them have a lot of people standing on the deck of the ship. I joked on Twitter, people with less knowledge and more money than you set the price in the market. Over time, they will get the knowledge, you will get the money. Right? Over time, what really matters is the underlying fundamentals. Right. And in the near term, you have panics, and the panics cause like risk off events. Like people panic because inflation is really high. And so they sell the inflation hedge. Huh? Tell me that again. Inflation is really high. The government can't get it under control. So there's a panic. So people sell the inflation hedge. And then the journalists and the modelers say, well, look, we've run a statistical model for the past week, and it shows that when inflation is high, people sell Bitcoin, so it's not an inflation hedge. Huh? Well, if you run the model over 2 years and you look at it since COVID, you can see it's up 229%. And it's pretty clear that gold is not an inflation hedge, and silver is not an inflation hedge, and stocks are not an inflation hedge. Right? And bonds are not an inflation hedge, and currency is not an inflation hedge. That's pretty obvious if you look at it over 2 years. But if you shorten your time horizon to 2 weeks, you can come to the opposite conclusion. But in my opinion, it's pretty foolish.